still on the desk with me, I've got Earl Davis of BMO, I've got Jim Thorne of Wellington-Altus, and let's pick up on that point. You can say that the bond market is selling off because of this higher for longer mantra that is being drilled in by central bankers. But you can also add to the fact that maybe it's the return of the so-called bond vigilante, the sort of last person to get in the way of fiscal spending. And we saw it show up in the UK in a major way in Liz Truss, her posting. Is it going to show up in a major way in the US, in Canada? Has it already shown up? How do you think about that?
It definitely is starting to show up. I do agree. Part of that's a risk premium around fiscal stability. I say U.S. is much worse, 7.5% to 8% deficits versus 2 to 2.5% in Canada. Having said that, I do truly believe it will be short-lived.
Why?
We will have, and part of it is the psychology of the market. It gets into a panic. It doesn't look at the actual level of yield. We are actually getting to very attractive yield levels if you're a pensioner, even if you're an equity holder, to switch into yields. And that's part of what central banks want as well, too. They want money to come out of the growth economy and go into savings. And that helps. So it's like the sell-off will create its own demand. But once you're in that volatile panic moment, it seems like people just extrapolate.
How do you think about that? You were talking about this return of the bond vigilante.
Yeah, when you give the credit to Tiff Macklin, let's just say the Bank of Canada knows what it's doing, right? Because I'm looking at the demand side, the interest rate sensitive side, and it's just like the economy's stopping, okay? So then you sit there and go, well, maybe he's unwilling to speak on the record, right? And, you know, you have Larry Summers in the United States saying Jay Powell has to start speaking on the record. Volcker talked about it.
Two governments. You got, you know, and then if you look at the Parliamentary Budget Office's report, right? They were excessively lenient in terms of basically saying, look, the economy is stagnating and basically the deficit is soaring. And their forecast is saying that the Bank of Canada is going to have to cut in April. So, and I think they're being way too lenient. So yes, I think if it's me, this is not normal times. If 2% is sacrosanct, right? Tiff Macklin needs to go on the record and basically say, this is out of the ordinary, but fiscal policy spending is inflationary. And I agree with Jamie Dimon. If this doesn't stop, the long end's going to get a lot higher. The long end, the 10-year, as Jamie Dimon says, could get up to 10%. If we do not get this fiscal policy under control, and I think it's... Do you believe that's a risk? I mean, 5% to 10% is a huge leap, and then you have noted hedge fund manager Bill Ackman saying, "I've closed my short." Now, I'd love for you to weigh in on that.
So I'll walk through our position. We're still short. We've been short for 2 years. Now we are not max short. We're 2/3 short. We anticipate we will get that significant...
And to be clear, you're short the
duration.
Bond.
Yes. So we're short duration. We don't want to own longer dated bonds. Thank you for that. But we anticipate this quarter before the end of the year, that big sell-off that may happen, could happen very shortly, a 75 basis point sell-off in 10 to 30-year bonds, but it will be short-lived. We believe coming into January and for 2024 will probably be a record year for bond yields in the rally. It's not time to buy yet. Is 10% out of the realm of possibilities? No, I wouldn't say that, but not immediately. That is a 2025 to 2030 story.
Look at this rare kumbaya.
Yeah. No,
We've got some agreement here.
So the risk to me in the thesis, the risk in the thesis and all this, and about higher rates and inflation, isn't right now. It's 27, 28, 29. So everything that this gentleman's talking about, it's timing. I think we have the echo of the COVID crisis. And if you look at World War I and World War II, we are walking ourselves into a deflationary, depressionary, or recessionary period. And then we'll figure out 26, 27, what that looks like. That's what history suggests.
But I just want to bring it back to the near term, because if you are concerned about the bond market and a further sell-off crossing past 5%, and who knows where that stops, that also tells me I probably don't want to be in equities. I don't want to be a dip buyer there as well. I mean, we already have the TSX, which is hitting a fresh low. It's crossed back below 19,000. It's trading at a one-year low. The S&P
big sell-off, kind of down 1%, the NASDAQ down 1.5%, all trading around multi-month lows. It seems like this, you've been rewarded for years dip buying, but if I see a world that is 5-6% bond yields, that's probably very difficult for equity investors too.
No, I don't think so. And part of the reason we talk about large fiscal deficits, but remember that money is going somewhere in the economy. If you look, it could be defense, it could be onshoring, it could be energy transition. That's jobs. That's growth in the economy.
Stocks can still work in this environment.
Yeah, I think it will be volatile. It's not going to be a straight line down, straight line up. But there's reason to be constructive of the markets in this environment.
Yeah, first off, I think the labor market is structurally tight, which means that in the United States, that means that everybody's working and they have 401ks. There's a separation between the equity market and the economy. Two, I think in the first half of next year that fixed income has a really good shot at outperforming a lot of asset classes, right? I think we have a really good shot of interest rates going down into 25.
So, okay, short term, you guys are concerned. Long term, you think we could see a bit of a relief rally in the bond market?
Yeah, short term being the next 3 months concerned. Long term is, I wouldn't say long term, but 2024. Remember, this is a historical rout in bonds. These 3 years down, if we were to end today, has never happened in the history of bonds. It's reasonable to expect that you get a bounce from that.
Yes.
I think it'll be 1 year for sure, and then I will reevaluate at the end of next year because there's a lot of cross currents. It's complex. You'll get a better sense as time evolves as to this fiscal growth, employment dynamic, and that will help determine at least the medium-term outlook.
The 10-year, we had a parabolic move in rates. The 10-year rate in the United States could go down to 275, short, like in the next 18 months. And this gentleman's thesis would be correct. That type of intense counter-trend rally is what we might. So let me just be on the record. It is not clear to me, like my base case scenario is that we're going back to secular stagnation and deflation because I'm learning from what happened with Japan, who's claimed victory on deflation so many times in my career and has never created, and we are looking at a lot like with our debt and our real estate market like that. But having said that, what I suggest to you is that, they have the Bank of Canada, and I've said to you over the time, Canada is not the United States. We aren't a diversified economy. And I think that Tiff Macklin and the Bank of Canada are taking a page out of the book of the Fed, and it's going to hurt Canada significantly relative to the United States.